One of the questions is how to invest in real estate for true financial freedom. And when people first reach out to me, they want to talk about real estate investing. A lot of the people initially form their goal around this monthly income number that they need to hit in order to achieve financial freedom. And the only reason they're interested in investing in real estate is to no longer need to work their normal job. And I think as simple of a math problem as that becomes, it's not a reliable one because, if you research real estate investing for any length of time, the problem that they're going to have you solve for is, let's say you need $2,000 a month to live. And you know that from analyzing one particular property, you're going to get $200 per month in cash flow. So if your cash flow per property target is $200 per month, then, simple math says that you need 10 of those in order for you to walk away from your job and never need to work again. And while that may work on paper, that is never the way that the cash flow from these actual real estate investment properties are going to go. So if that is the goal that you have in mind, I truly believe that you're setting yourself up for failure because that is just, from my experience, not the way that cash flow works. While you may have $200 net cash flow allocated when you list out all the expenses of one property, and let's say that you think you're being very conservative in including 10% for capital expenditures, 10% for repairs, maintenance, and 4% vacancy. So you're padding those numbers by allocating 24% on the monthly basis to the quote unquote unknown or potential things that happen. Well, I think there are two main issues with that. First, none of the investors that I've ever met that analyze properties this way actually have a bank account that correlates appropriately to the capital expenditures or repairs and maintenance. Most investors do not have a capital expenditure fund that they put 10% of the rent collected in on a monthly basis. Similarly, they do not have a repairs and maintenance bank account where they put 10% in on a monthly basis. And very much so, I would say this is the one that no one does, is that 4% vacancy. Nobody has a vacancy account that they put 4% in on a monthly basis and then take out anytime that property has vacant in a monthly fashion. Since that isn't done really by anyone, I think it's a silly way to analyze properties in that sense as well. Now, I think it's prudent to save for things as they and will go wrong. However, allocating that, thinking that you're safe and thinking that you are going to be able to remove $200 on a monthly basis in order to pay for your lifestyle, I think is a little bit aggressive and unrealistic. Because the second thing is in the fact that cash flow doesn't work this way is, let's say a capital expenditure event does occur, like let's say the roof needs to be replaced and the roof is going to cost you $6,000. Well, even if your property is rented out for $1,000 per month, your 10% capital expenditure rate, $100 per month, you're talking about 60 months of collecting this capital reserve or capital expenditure or CapEx repair just to pay for this one roof. So you are immediately 5 years behind whenever this occurs. Now, in the event that 5 years passed and this roof does or is paid for solely from your capital expenditure reserve, your 60 month of $100 per month savings pays in full for that roof, then now you are set with a capital expenditure fund of $0. And now you're fingers crossed, hoping that nothing happens on that property that may be needed then. So your furnace, your water heater, your siding, anything to do with the exterior, you're just kind of hoping that that doesn't happen until you accumulate enough funds. So in the event that your capital expenditure fund is not fully funded to pay for that roof repair, then ultimately what's going to happen is you're going to see that you have $1,000 set aside, $1,200 set aside for this property for unknown things to occur. You're faced with a $6,000 bill. Where does that money come from? If it comes from another reserve account, then you owe it to yourself to replenish that reserve account, right? And what do you do with that? You're probably going to use your $200 per month that is quote unquote net cash flow. That is one of the 10 properties that you need to retire to replenish that reserve, so you're not left with unnecessary exposure. I hope that makes sense. And I hope you can see that that math problem is extraordinarily faulty, because the fact of real estate investing is, even if you are buying a brand new house, it is a ticking time bomb. Everything that this house is designed to do is not the way that nature intended. Weathering, beating down, and causing maintenance to be necessary on your property. So I would say, realistically speaking, most properties need to be fully replaced on like a 70-year basis. That is a significant amount of money. Even if you have a bunch of preventative maintenance stuff, roofs go out when they go out. Hot water heaters can only last so long. Floors get worn from foot traffic. Paint gets dirty, gets faded. Windows break, concrete cracks. All of these things happen. So the financial freedom inside of investing in real estate doesn't happen from the cash flow of the set number of properties that you are setting out to get. I think the underrated ways to make money in real estate investing long term, to truly start creating financial freedom for yourself, comes in the appreciation that you are ultimately going to be able to recapture via lines of credits or cash out refinances. I think it comes in the principal pay downs of the loans that you use to acquire these properties. You're also going to be able to recapture those via refinances or lines of credit. The tax benefits you're going to be able to make as you accumulate a portfolio. You're going to be able to make more active income without realizing so many taxes because of all the depreciation that you're going to accumulate. And from the cash flow perspective, the way to get some financial freedom there is by doing enough volume on the real estate side that the cash flow from any of these properties insulates you from needing to pay for them from your active income. We experienced this when we had over 20 properties. Now, we went from 8 properties to 21, but in looking and talking with other people that have smaller portfolios, I think 10 is that magic number. So I think everybody needs to get to 10 properties absolutely as fast as they can in order to be able to sustain themselves and their portfolios long term. Once you get to that 10 properties, or for us, that 20 property mark, then what you're going to notice is the cash flow from all of these properties are sufficient to cover any one thing that goes wrong with those properties on a monthly basis. So you're going to be able to start tapping into these laws of large numbers or laws of averages, where you are not personally needing to come up with the funds to repair that roof. You're not banking on, this 10% that you're setting aside on a monthly basis in order to hopefully accumulate to the point where it's sufficient to pay for that roof as it's needed. In the event you have 10 properties, the chances of all 10 of those roofs needing to be replaced at the same time is very low. So if you have 10 properties all rented out for $1,000 per month, then your 10% capital expenditure and your 10% repairs and maintenance are now $1,000 per month for the capital expenditures and $1,000 per month for the repairs and maintenance. So now you have $2,000 per month. So now in the event that you have a $6,000 roof that needs to be done, you have 3 months worth of those things set aside, or it's going to take you 3 months to replenish your capital expenditures. Now, as your numbers grow and as the amount of cash flow that you're bringing in goes, this effect compounds, and you're going to reach a point where you have more money coming in than the repairs necessary to address all of the accumulating deferred maintenance on your portfolio. So to recap, the true financial freedom that exists in real estate investing is inside of the appreciation, inside of the principal pay down, inside of taking advantage of the law of large numbers, having more properties. The more you group together, the easier it's going to be to sustain the individual properties themselves. And to also add one more thing at the last minute, is real estate is also an industry where you're able to purchase property for less than what it's worth. So the formula that we are always running is purchase price plus rehab costs is equal to or less than 75% of that after repair value. Now, the reason that that formula is important is, let's say a property is worth $100,000, the most that we are willing to be in on that property is $75,000. So each time we purchase a house using this formula, assuming that all of the homes we purchase are worth $100,000, then each time we purchase a house, we're walking into $25,000 worth of equity. Now, that always comes with strings. Generally, there's some type of deferred maintenance that needs to be immediately addressed on the property that is going to take capital to put in, but that is factored into those numbers. Or maybe there is deferred maintenance on the business or the admin side of the rental. So maybe it is rent that is really below market. That is another reason, below market rents, that properties will go for lower than what they're worth. But real estate is this unique thing where you're able to take advantage of, I'm tempted to call it the arbitrage between the value of the property and what someone is willing to accept for it to be able to walk away from it. If you're able to walk into equity and then you're able to experience appreciation, then you're able to, if you leverage it to 75% loan to value, you're going to be able to pull out all your initial capital, which again is not a taxable event. You're going to be able to take advantage of the principal pay down on that money that it's a loan. You've already received the funds back. And then as you create volume, you're going to be able to take advantage of not needing to personally pay for these repairs, or your business need to personally pay, because the incoming rents are more than sufficient to handle the maintenance on these properties. And then as enough time passes, that appreciation that is always happening in the background, that principal pay down that is always happening every single month, that these residents are making those mortgage payments on your behalf. Every month that happens, your net worth increases. The amount of capital that you're going to be able to one day tap into and take out via a cash out refinance or a line of credit, which again is not a taxable event, that is going to grow and grow. So setting out to retire with 10 rental properties to replace your $2,000 per month living expenses is an unrealistic idea. However, replacing your $2,000 per month salary with 30 rental properties is a very realistic idea. And also in doing so, you're going to have the ability to access additional capital based on the amount of equity that you are generating on a very regular basis. What a long explanation that was to one video.
Thanks for watching that clip. I thought that was a good question. And I think you can ask good questions too. Join us every Friday morning at 8 a.m. Eastern Standard Time for a live stream Q&A where we answer plenty of questions just like this one. In the meantime, consider subscribing to the channel if you want more of this content. And if you want to increase your deal flow, analyze properties better, and help me feed my family, click the link below for a free 7-day trial of PropStream.